Yeah, perfect.
Yep.
Excellent. So I think I recognize most names from yesterday, so I won't go over the introductions in too much detail again. Today's workshop is around how to communicate your financial plans to investors, what sort of things you need to be thinking about when you come to creating your plan. And also another topic that we get asked about quite a lot is how do you fundamentally value your business, or how do you even start to think about that? So they're the two key topics for today. Briefly, just as I mentioned yesterday, the firm I work for is Dragon Argent. We combine various professional services to ensure sort of conjoined services across many core competencies such as accountancy, taxation, corporate legal, commercial legal, and advisory. And anything that we feel like we can't do internally, we tend to have a network of advisors that we trust. That means we can continue to sort of bring our experiences together and provide everything in sort of a more conjoined way. So that covers everything from data protection to IP and litigation, more advanced areas of tax. My role is as head of accountancy, hence why I'm here today giving this workshop on the more financial side of things. So yeah, recap of yesterday. Financial planning is obviously important. Fundamentally, it's essential to manage your cash and cash burn. And as we talked right at the end of yesterday's session, the more that you are proactive about managing this, then the less likely you are to run into any sort of nasty surprises further down the line. You're also giving yourself the best opportunity to think about how you grow the value of your business and also communicate that effectively with your investors who will want to see that you've been putting some thought into this, essentially, to understand exactly what does drive your business. So moving on to today's workshop, I'll briefly touch on the key value drivers of a company again, just because there is relevance in that into what I then go on to speak about further in the session. I'll then explain the scale of the opportunity and why you guys are all fortunate, I think, to be having a startup in the UK, why the UK is quite investment heavy, and why there are a number of hubs and a number of people like yourselves that are able to start a company and have a reasonable chance of making a success of it in the UK. I'll then go on to talk about how to consider evaluation of a company, how you might present your finances and forecasts, both for income, expenditure, and then cash flow as well. And then any other considerations that you should be having at this point, which talks quite a lot about understanding your target market, because I think fundamentally that's a huge part of creating your forecast is the understanding of your target market. We'll then have a quick recap over what I think are the more important points of today's session, and then similar to yesterday, we'll have a little Q&A at the end for any outstanding questions. Like I said yesterday, do feel free just to shout up during the workshop. I know it's not the easiest thing to do on Zoom, just to sort of butt in and ask questions, but do feel free to do so if anything I've said doesn't make sense or spurs questions for you. But let's get stuck straight in with the key value drivers. Again, just to cover off from yesterday, the bottom of this screen says a regular question: how much is my business worth? And that is something that we're asked very, very regularly, and is very hard to pin a specific answer on it. Ultimately, a business's worth is dependent on so many intangible factors, primarily the value proposition that you have, the product that you're creating, how credible you are as an individual, but also all of the various things that you see on the screen here. In terms of forecasting fits into both the management information section And in terms of your smart strategy, you want to make sure your forecasts are in line with your objectives and aims. But I think the main one that we need to be aware of today, and why I've brought this screen up again, is the one in the bottom right, which is potential buyers. Ultimately, you can derive value for your business in so many ways, but if there's no potential buyers, or for buyers, you can read investors if you wish. If there's no interest in your business because you've not got out there and sort of found people who might be interested, then your business isn't worth a lot particularly. So it is very important to understand how to sell yourselves to a potential buyer. And with that in mind, that's what we look at today in terms of trying to create a forecast that a buyer would take an interest in. Again, I refer to buyers, but that can be investors who want 5 or 10% stake of your business to sort of speed up your initial growth. In terms of valuing a business, the number of buyers that you have is a massive factor in how you value a business. If you've got one potentially interested party, that will massively downgrade the potential valuation that you can get when you're selling a portion of your business, which has a knock on to how much dilution, how much percentage of your business you're giving away. If there's a number of interested individuals, the market can then start to create itself. You'll be able to see generally sort of price points that people are interested in and negotiate against each other to come to a price point that works for you when you're looking to give away 10 or 20% of your company, or whatever that could be. So I just wanted to bring that up again today, just because we will touch on the significance of potential buyers quite a few times throughout the workshop. So hopefully you're all aware of the scale of the opportunity that you all have. Otherwise, you wouldn't necessarily be doing what you are today. Investment appetite in the UK is huge. There's a number of schemes which I hope that you are aware of, and if not, it's something that you should probably become aware of, such as EIS and SEIS, which are designed to incentivize investment into small businesses in their early years. So these schemes have various criteria. Mostly they're set up to target businesses which are under 3 or 5 or 7 years of age, that are sufficiently small and essentially inherently risky, as all startups are, to attract investment into those companies, so that individuals who do have a good business idea but not necessarily the cash to fund it have a resource with which to be able to build their business. I wouldn't profess to be knowledgeable about all of the incentivization schemes globally, but it's well known that the UK, for companies who are developing technology and developing businesses from scratch, the UK is a great hub to be in for that, due to these tax incentivization schemes. So using an EIS or SEIS scheme, if you're eligible, which I would assume that all of you probably are, attracts income tax relief for the investor, which can be worth up to 50% of the value that they're investing. So as an example, if there's a high net worth individual who has a tax bill of 100,000 that tax year, he could invest 100,000 into one of your businesses and obtain 50% tax relief. So he only has to pay 50,000 to HMRC. So what he's essentially getting there is half his tax bill as a free roll of the dice to throw at a startup that he perceives to have a high level of potential for growth. That 50,000 could be worth millions years down the line. So the investment appetite, as it says on the screen there, is huge in the UK. Generally, most startups will be qualifying. I would imagine, like I said, all of yours probably are eligible. There's some limits on the age and size of the company, which can make some startups ineligible. But I would have thought that would only be a consideration for you 2, 3, 4 years down the line, maybe, as your businesses grow. The added advantage for the investors in using EIS and SEIS schemes is if they invest in a company and hold their shares for over 3 years and then sell those shares, any gain is exempt from capital gains tax. So using our example from a minute or two ago, if someone invests 50,000 in your business for a 10% stake, and then 5 years down the line, your business sells for 10 million, their 10% stake at £1 million, they won't be paying any tax on that gain due to investing through EIS and SEIS. So it just all adds up to becoming a very welcoming market for high net worth individuals to put their money into, essentially. Another incentivization that the government have is R&D tax.
Craig?
Yeah?
Sorry to interrupt. I saw that there was a question coming through in the chat. If you
yeah, sure.
could address that as well, please.
No problem. Yeah, so as Ellen says, SEIS is only for up to 2 years of founding company. EIS runs on to much longer than 2 years. So SEIS tends to have a shorter lifespan, and it's for smaller businesses, and the tax relief is at 50%. Beyond SEIS, then most companies will still be eligible for EIS for a number of years further. The tax relief drops to 30%, but it's still very incentivizing for an individual that has that sort of money to throw at small businesses. But no, that's a good point.
Sorry, Craig, can I ask a quick question? So basically, if an investor like goes and puts like 100K in a company with SEIS, so he would get a tax relief of 50K or of 100K?
He'd get tax relief of 50.
Oh, okay, 50, right.
So you get tax relief under SEIS of 50% of the amount of your investment.
Right.
And under EIS, that drops to 30%.
So technically, if they're actually investing 100, it's costing them 50, basically.
Yeah, exactly. It still does cost, but obviously the cost of their investment is reduced by the savings on the tax.
Right. Thank you.
No problem. So the other incentivization that I want to come on to is research and development tax relief. Again, something that you possibly should be aware of, and if not, something that you can read up online, or feel free to get in touch with me for a 10-minute call to discuss it further. But ultimately, if your company is making an advance to science and technology, which in most cases I would expect that you are, then you can receive a cash rebate on any costs that have gone into your business. And those costs can be your salaries, if you're paying yourself a salary. If you're paying developers, those costs would be eligible. Any software costs or third-party expenditure for subcontracted costs or third-party freelancers, any directly attributable costs to the development of your product, you can receive a tax rebate from HMRC. Again, it's just another way that they try to encourage R&D development in the UK. And while you're in your loss-making phase as a business, the likely tax rebate that you will get is around a third of the eligible expenditure you've incurred. The terminology which is used by HMRC is a tax rebate. That's not necessarily true, because in your first years in business, you might not be even paying tax if you're running at a loss, in which case it's just a full cash rebate. HMRC will pay around a third of your eligible expenditure in cash to a loss-making company, which can then obviously be reinvested into further development for next year and then reclaimed. So with EIS, SEIS, R&D, and entrepreneurs relief all in mind, then there's a lot going on there to attract money into companies such as yours and hopefully spend it wisely to grow the company. Entrepreneurs relief at the bottom of the screen, again, something some of you may or may not be aware of, but for entrepreneurs who own their own personal trading company, at the point of sale, then the tax rate that you will get taxed at on the sale is only 10%. So if you compare that to normal income tax rates that even the basic rate of income tax is 20%. So ultimately building your own business and selling it and getting tax of that at only 10% is, again, another incentivization to you guys to actually hope that the work that goes into your business over the next few years won't just end up in the taxman's pocket. So there's a lot of ways that the UK government have created just to incentivize both you and investment into the company. Yeah, Elan, I think you've got a question.
Sorry, great. Quick question. Did you say the entrepreneur's relief is only for personal? So one person that owns 100% of the company, or is it for all the shareholders in the company?
No, so it's for anyone who has what's called a personal trading company. And a personal trading company, by and large, is anyone who owns over 10% of a company for at least 2 years. That's the most simplistic way of explaining it. There's a few less important criteria, but for example, if your company gets diluted down from the 100% ownership that you might have today, and you get an investment, and in a few years you own only 50%, that will still be your personal trading company so long as you continue to own over 10%.
Okay. So when you sell, all the shareholders that have that criteria will get that same tax relief then?
Yes, so long as they've held 10% for over 2 years, yeah.
Okay, right, thanks.
No problem. So the next slide discusses how to value a company, and to set some expectations here, there is no necessarily right or wrong answer to value a company. Clients regularly come to us hoping that we can give a monetary answer of what price point they should be looking at, which we can do with quite a wide range, but it's impossible to accurately explain or calculate what a private limited company might be worth, or what a 10% share in a private limited company might be worth, simply because no market exists for free trading. Obviously, with larger public shares, there's unlimited buyers, unlimited sellers. The price can fluctuate and determine itself. For companies such as your own, the value will ultimately be how much you perceive a 10% share might be worth, and how much a potential buyer might perceive it to be worth. That said, there's a lot of things you can look at to determine whether a company is high, medium, or low value. The 10 value drivers that we've discussed a couple of times being one of them. But those 10 value drivers are inherently intangible. It's very hard to attribute a value to the efforts that you guys are putting into your business. On the whole, a lot of you won't be paying yourself salaries, but you'll be spending a lot of time developing a product. So how exactly you value that is not an exact science. Of course, you want to be valuing the outputs rather than the inputs. So you could spend £10,000 on various inputs into your product, but that doesn't define the value of your product, because you'll be adding value to that through the development that the efforts that you're putting in, essentially. As I said, the limited buyers in the market do mean that it's very difficult to give an accurate value of the company, and often you'll have to be led on the offers that you're receiving. If you want to raise £500,000, for example, an investor will specify the percentage of the business that they want to receive. You might have a very different percentage that you think is fair to give away, and the right answer will probably be somewhere in the middle, and it becomes a bit of a negotiation point in terms of how much you need the money, or if you can get more money for the same percentage, for example. Again, I referenced Dragon's Den yesterday, and we've all seen that negotiation tactic, and that shows basically the be all and end all of how to value a company. It's in the eye of the beholder, and the initial beholder is you, and the next beholder is the person who wants to purchase a proportion of that. So it's very difficult to ascertain an exact value from an early stage due to all of the intangibles which are in play. Yeah, Elan?
I think that might be a previous hand.
No,
Okay.
yeah, sorry, no, didn't have any questions.
No worries. Hannah,
Craig, can I just ask though, to go into the conversations with investors, obviously it's helpful for the entrepreneurs to kind of have an idea beforehand. So rather than just hearing what the investor, what their opinion is, what kind of, is it similar companies at similar stages with a similar product, or like what kind of bits and pieces can they look at to have an idea before going into that conversation?
Yeah, so part of that market knowledge of similar companies with similar products, like you say, will be relevant. It's probably likely that the investor might know more about that than the individual who runs the company, because what you'll find going into investment, or if you're looking to raise investment, is that many investors will have specialist areas that they look to invest in regularly. So they probably will compare your business to other similar businesses, not only at your stage of growth, but maybe 2 or 3 years further down the line, and try and ascertain the likelihood of success for your business. So that's definitely one aspect of it. The other aspect, which is the bottom bullet point on this screen here, is financial considerations and projections. So further on in this workshop, we'll come on to how to create these projections. But ultimately, if you can create some assumptions which have a level of accuracy or credibility to show how your business might grow and where you think your revenue streams might be at after a year or two, and have evidence to show that you think that it's likely that you'll get there, that will also factor into the valuation as well. So in terms of financial considerations, that's where you will know more than the investor. So the regular ones that the clients of ours would think about, or companies such as yourselves would, is things such as EBITDA, which is essentially profits, future cash flows, assets in the business, but also how you're spending your cash. So some investors might look at profits, but it might not necessarily be your objective to create profits. You would probably value a business higher that has higher revenue, that is using all of their revenue to facilitate more growth. But by the fact that they're utilizing all their revenue, they might be diminishing their profits. So turnover is very, very important, and probably the most important factor, I would say, is how you expect your turnover to grow over the coming year or two. And to project that as we go into further in this workshop, it requires quite an intricate understanding of your target market, who your target market is, and how you're going to sell your product to that market. Again, investors will probably assess you on various other criteria, such as the 10 criteria we were looking at before. One key one that we see quite often really diminishing the value of a business is owner reliance. If a client wants to sell their business, but the owner of the business wants to exit and not be involved in the business after the sale, it becomes much less valuable to a potential buyer if the business is very reliant on that owner than if there's a real strong managerial team that will remain. So there is a lot of moving parts, but from your perspective, something that you can control is to ensure that the business grows without being overly reliant on yourself, and also that projections are in place to try and communicate to the investors why you think the business will be a success in the future, which is what we come on to in the next section. As I said, value can often be in the eye of the beholder. So a valuation can be adjusted for considerations of mutual efficiencies, for example. In a lot of cases, there might be a situation where a competitor wants to take you out of the market. And in that case, your valuation might be artificially high to that competitor than what the valuation of your company is to yourself. Because for the competitor, not only are they acquiring you and your commercial contracts and your expertise and your staff, which has a value, but also they're getting the intangible value of removing you as a competitor, having more market growth, but also possibly economies of scale. The duplication of the businesses might create cost savings for the purchaser. So again, it's important to always understand who exactly is looking to purchase the business. I can't remember who it was at the end of yesterday, but they suggested very cleverly actually that in certain cases, individuals of high net worth might be more or less interested in investing in a company under EIS or SEIS. For example, we're coming towards the end of a tax year and an investor might be aware that he hasn't done any EIS investments yet this year, and that would be a tax saving if he can complete one during the remainder of February and March. So at this point, your value might be artificially high to any EIS or SEIS investor because the appeal of investing in you right now is heightened because it will provide them tax relief before the end of the tax year. So valuing a company, there are so many moving parts, but one thing that you can look after is sort of presenting your finances and your cash flow forecast, which is what we come on to now, and will probably be the bulk of the remainder of the webinar. We'll be discussing quite where you start and what you're looking to achieve.
Alistair, did you have any comments? I saw your hand was popping up for a second.
No, I was just taking credit. Thank you, Craig.
Yeah, no problem. It was a sufficiently good question that I remembered.
It's an old sales trick. We call it the burning platform. Try to get target buyers in a position where they have no choice. But it takes a bit of juggling, but works when it works.
Yeah.
I thought I would actually have a follow-up to my question you had before, and then to your answer as well, in terms of investors being able to value and everything. How can the entrepreneurs kind of navigate? Because obviously the investors will have a vested interest in preferably as much share as possible for as little money as possible. So how do you respect and take into consideration that they will have the expertise of understanding what your company is valued, while at the same time being careful that they're not undervaluing what the company is actually worth?
Yeah, I guess it comes down to negotiation, and the negotiation on your side is making the company look as attractive as possible. And you can do that in several ways, but I think if I just jump back a couple of slides, it really is ensuring that these key value drivers, that you can really tick off a number of them, if not all, because not all of them are going to be possible at any point in time. But if an investor comes to you and they're trying to suppress the value of their business, which, like Hannah said, they will do, they'll want the highest percentage of the business for as little as possible. If they come and do that, but you can come back to them and say, you've already built a client mix that has recurring, repetitive, known revenues. You've got a number of potential buyers that you can also negotiate with. These sort of things help put the ball back in your court a little bit, just to make sure that the negotiation isn't all one way. If you can't really tick off a lot of these value drivers, then the potential investor will know that you're in a bit of a desperate state for money, essentially. If there's no other potential investors there, that would be a key one. Having a negotiation with multiple different potential investment avenues will always help drive up your price. And yeah, it's partially the intangible aspect of how good your product is. How good are you at actually getting that to the market? Have you defined your target market? And ultimately, how much money do you think it will make in terms of revenues and profits? And how reliable are your aspirations on how much money it might make as well? So the more you understand your own business and understand your own market, the better position you'll be in terms of negotiating with an investor, and the more that you will feel comfortable standing up for yourself if an investor seems to be giving you a particularly bad investment opportunity. Does that make sense, Hannah? Cool. So skipping forward now to actually presenting your finances and cash flow forecast, and this was a question I think I deferred from yesterday, just because it does form at least 10 or 15 minutes of what we're going to talk about now. How do we build this from scratch, and what assumptions do we build into our forecasts? As we've discussed, evaluation is somewhat finger in the air, depends on many factors, the purchaser, the seller. So for credibility, if your valuation relies somewhat on your projected financials, then the assumptions and the figures that you're putting into your financials have to be somewhat accurate. There's certain figures that are easy to have being accurate. The current financial status of your company today, for example, you should be very capable, not necessarily yourself, but with the assistance of your accountant, to create a balance sheet today which shows the assets and liabilities that the company has as of today, and a historical picture of what you've been spending your money on previously and where you've got to today. So the starting point in preparing your financials will always be, where are you today and what has been the story so far, which for many startups is quite straightforward, and it only forms a small part of the overall picture. However, they need to be accurate, otherwise the credibility of the overall financial projections could be called into question. If you can't accurately show the picture of today, then why would an investor believe that you're accurately showing a picture that's accurate for tomorrow, which is just inherently more tricky? So once you have the accurate picture of now and history, that's great. It leaves your finances in a strong position for if they come up against due diligence, for example. Investors might want to do some digging into those financials that we provide today, and you'll want them to stand up to that due diligence. But the likelihood is that investors are going to be much more interested in tomorrow and what's happening in the future. And part of that, they will rely on how interesting they perceive your product to be, but also they'll want to ensure that you've done some work on the projections and your finances, and they'll want growth, and how your financial projections can articulate that growth and the revenues and the profits that you're expecting will be an important factor in that conversation that you have with them. An accountant can help with this and ensure that everything looks smooth and ties into the overall story of your business, and that you're not falling down potholes or anything like that. However, what an accountant can't do is accurately depict, without input from yourselves, exactly how you're going to sell your product in the future. That's something that the onus becomes then on the owner of the business, or if not the owner, whoever's in charge of the sales side of the business or the commercial venture. The onus is much more within the business than what it can be on the accountant. And it becomes sort of a two-man task to ensure that the projections look sensible in the future. What I would say is that you don't want to over model. Generally, I would say a 3-year projection is suitable. And then you would split the 3 years up into short-term, medium-term, and long-term. As we'll go into, there's slightly different considerations in all of those different time periods. In some cases, it might be that 3 years is slightly too short. If you don't think that your business is going to be commercially viable because it'll take 2 years of development, for example, then you might want to project, say, 4 or 5 years into the future. The key being that we do want to show the point at which the product becomes commercially viable. But the more years that we project into the future, the less accurate they're going to be, the more variables there are. And in all honesty, the less importance the investor will place on it. I don't think any investor would realistically look at any projections that we could create for your businesses looking into 2026, 27, and place any real reliance on it, because it is just so unpredictable. Of course, you can plan your business that far ahead. That would be sensible, just not necessarily in the detailed context of a financial plan. So, as I said, I think you should probably start by dividing your projections up into a short term, a medium term, and a long term. And we'll assume something along the lines of your business will become commercially active after a year of development, so after year 1. And then you've got the second and third year as the medium term and the long term, respectively. So the short term, obviously, we will start with first. And that's probably the easiest part of the projection, besides what we've already discussed of being figures that are either current or historic. So in the short term, we touched on this yesterday, so I won't overlabor the point, but investors are going to want to know what you're spending their investment on. They'll want to know how it's going to improve your business, how it's going to drive growth, why you need it. So in short-term planning, budgets are quite important. If you want to raise 500,000 for a year runway, you should probably be looking to allocate that expenditure across various areas. A lot of the time that will be product development in the early stage. You might have some freelance staff you want to bring on. You might hire someone to do some marketing to try and enhance the brand across your target market. So investors will want to have a good idea of why, if they invest now, at the point at which cash runs out, why will your company be more valuable at that stage than what it is today? So having a fundamental understanding of your strengths and weaknesses as a business and how you're going to utilize any investment money to address those weaknesses or develop opportunities is very important in the short term, in the first sort of 6 to 12 months of the business. I think you'll probably all agree that you should understand your business well enough to know that if you were given £500,000 overnight, what would you spend it on? And that's all the short term of the financial model is, until you get to the point of commercial viability. So in the medium term, that's when things become a lot more difficult. And that's where the person who understands the business or the sales of the business will need to sit down and give it quite sufficient thought. There's no sort of magic bullet where an accountant can just create a nice projection for you, because beyond knowing your names and the names of your business, I have absolutely no idea about how you plan on taking your product to market and what your target market is and how you're going to sell your product and all these sort of things. So whilst having an accountant is a valuable part of the process, there will be a stage at which you do need to sit down and really understand your target market and how you're selling your product to that market. Investors will obviously want to see a route to market. They will expect commercial viability at some stage. And they'll probably expect it in this medium term, sort of 1 to 2 years, hopefully, which makes this part of the projection probably of the main interest to any third party looking at it. And it's of main interest, but also the hardest. What you shouldn't concern yourselves with, though, is that it doesn't have to be perfectly accurate. No investor or sensible third party will wave your projections at you a year or two down the line and hold you to account on accuracy of the figures. Of course, they'll want to see progression, they'll want to see development towards where you think you'll be, but it's impossible to project 2 years into advance for even a developed business that becomes a lot more predictable. Never mind a business which is only just starting out, where you might still be unclear on exactly how you're going to spend your funds and how you're going to sell your product. So all you should be thinking of at the moment is that your projection cannot be better than an educated guess. Educated being the key word. Your projection being presented as an educated guess to an investor, they will have questions which will determine how educated your guess is. You can't just come up with figures that have no underlying assumptions. The thought that you put into the assumptions in how you're going to sell your product is important, so that you can stand by your projections and argue the case for them if needs be. So step one in creating the financial projection is actually understanding what you're going to do a year down the line. Until you do that, it's very, very hard to forecast and create this projection. So taking that step back will enable you to start building the model based on the assumptions that you come up with. So in terms of assumptions, and these answers will be different for all of your businesses potentially. In a lot of cases, they might be similar if you all got similar engineering backgrounds, but what is it you're selling? How many products are you going to have? When do you think commercial viability will arise? How are you selling your products? Is it business to customer? Is it to other businesses? Will you be selling licenses to use the product, or will the price be dependent on usage from the end customer? Or will the end customer have a number of individual users, and will the price you charge them be dependent on those end users? So you really need to understand the product that you're selling and how you're going to sell it, sort of product by product and month by month. In terms of projections, if you're selling based on licenses, then that's the easiest revenue to project. If you license a product to one of your clients and they can use it over a 12-month period and they pay X per month, then of course that can be fairly easy to project, because all you need to understand at that point is how much you'll license it for and how many customers you might have. It gets more tricky if your price is dependent on usage, because then you've got to project usage as well, and it all gets a lot more tricky. That's not to say that the best answer for your business is to sell in terms of licenses. It's just that would be the easiest way to project. So beyond that point, you might be thinking of initially when sales are going to be generated, but also what development milestones do you have in the pipeline? Are there going to be certain points of time where once you hit this milestone, your valuation should jump up? Obviously commercial viability being one, but some of you might have in mind to create a beta version of a product which goes out to a very small number of users initially, followed up by a second version and a main release and all of this sort of thing. And all of this involves consideration of pricing, volumes of sales, production costs, and all of this sort of thing. And each business is so different. There's no necessarily one size fits all answer. It really does come down to understanding your own business and understanding the market that you're selling into. In terms of trying to get answers to these questions, I would hope that some of you have some idea of exactly how you plan to sell your products eventually, but you have no sales history to fall back on. So again, it's not as easy as what you could project for a more established business. With no sales history, how do you exactly understand how things are going to progress? So what you might do is obviously market research, understand who might be interested in your product, speak to them. There's no harm in speaking to them about your product, even if it's not yet relevant because it'll help you understand their needs, their behaviors, exactly how they would value your product, which might then add knowledge to you when you're concerned over how you're going to sell it, determining whether it would be on a license or usage base, because ultimately whatever your end customer wants is going to be the best solution for yourself. You might look at any similar products or rival businesses which are out there, considering within the engineering sector, how do businesses like yours usually sell? Is your product seasonal at all? All sorts of things that ultimately are down to the company to really understand their target market and other market dynamics of where they're operating in. Once you consider those sort of questions, then you can think about, once you get the product off the floor, then how do things move on from there? How many customers are you likely to gain each year? Are they going to be one-off customers, or will your customers keep coming back for more month after month, year after year? Will they continually spend more with you? Will there be an initial contract fee for setup? Or will the initial cost of setup just be built into the contract that spans the course of the year, for example? How long might that contract last? Will their usage grow, which could have a knock on to your revenue? That it all comes down into how you're selling your product and how your customers want to purchase your product. Will you lose customers? Do they only need your product for 1 year and then they'll move on and not be repeat customers? What would be an average sale to an average customer? Will you bring out updates on your product that customers are going to have to buy? Will there be further releases? Will there be supplementary products? All of this sort of thing is just vitally important to really nail down in order to start building the projections. And I can't really emphasize enough, until you've got the answer to all of these questions about your product and your target market and how you address that target market, then once you build the answers to these questions, then your projection will start to fill itself out once you put timescales into your answers as well. So something that you need to consider whilst doing this is that when a third party looks at your projection isn't likely going to have the answers to all of these questions on the face of the projection, but you need to anticipate the questions that a third party might ask when looking at the high level projection. They'll likely ask all of these questions that I have just posed to you, in terms of how your clients and customers are going to use your business, in terms of if it's repeat business or whether you'll need to constantly regenerate new business. They'll want to ask questions digging into the assumptions that you have made when building your revenue projections. I do think that this medium-term sales projection is by far the hardest area of creating a financial pack for potential investors. And it's hard because it does really require intricate knowledge from the entrepreneur into how it's going to work, and then tying that up with an accountant or a corporate finance individual potentially, to articulate that into building a financial model, which then not only incorporates the sales but associated production costs, overheads, and therefore cash flow as well. So I would say in step one, if you can't answer the questions that have been suggested over the last 10 minutes or so, then it's possibly a sign that you need to take a step back and understand your target market in a much more detailed way. Knowledge of the target market is absolutely key, and the onus is probably going to be on you or your sales director to understand that target market. once you've got through that initial medium-term product to market area, the long term, again, as I suggested earlier, is harder to project, but this is understood by a third party. In the long term, they'll want to see growth of revenues, growth of profits and sales, and growth of the business as a whole. However, there would be no expectation from an investor for you to project intricately 3 or 4 years ahead. So my recommendation would be to nail down the part where you're taking the product to market, and then building growth rates from there forward. Determine how much you think you might grow year on year, with some explanation of why you think 20% growth or 30% growth or potentially 200% growth might be reasonable. And then just apply your growth rate to your sales. Whilst doing that, you would probably expect that your sales will increase more quickly than your costs. So that would be a consideration in your long-term projection, simply out of economies of scale, efficiencies of scale. As you produce more, your cost of production should, in theory, become easier and cheaper. So your gross and net margin should increase as your long-term projections move further into the long term. But yeah, I wouldn't place too much emphasis on the long-term projection beyond trying to paint a picture of optimism. As I said yesterday, if your own projections don't show confidence and optimism, then it's hard to see why an investor should show confidence or optimism in your business. So you have to nail the reliability of the midterm with your underlying assumptions, and then show that growing over the medium to long term. I guess something else that would be worth pointing out for the medium to long term projections is that every investor will be different. A few of our clients go through investment rounds and projected financials aren't even requested or looked at. They can see the value in the concept, and they know that the concept will sell. They understand that sales point hasn't hit yet, and the entrepreneur has been more concerned in the development of the product. So each investor is different. Some investors will come in and go through the financials with a fine-tooth comb and ask a lot of questions. So you do need to be prepared for the questions. But second guessing exactly what each investor wants is hard. So you need to be understanding when you do show your figures of where the numbers come from, so that you can justify those headline numbers when asked, because an investor could ask about any of the headline numbers really, and you'll have to explain the assumptions behind those growth rates and where you've got the figures from. So other considerations at this point, and we'll touch on target market again here. The effectiveness of your business development will arguably have the largest impact on the valuation of the company. As I just said, an investor won't only care about financial projections. They're very useful because investors will care for revenue growth and profit growth, but they can derive comfort from that from elsewhere, through your expertise as individuals. And if you've got a genuinely excellent idea, an excellent product which will satisfy demand, then the company will attract investment interest. In terms of selling that to investors, either through financial projections or otherwise, like I said, I can't emphasize enough the clarity around your target clients is so important. Because if you can't accurately define who your target clients are, firstly, you won't be able to create a projection very reliably. But secondly, it would be very hard to actually persuade an investor that you know how to make this product commercially viable. It's not really any use having a great product if you don't know who to sell it to and you can't sell it. So having clarity around target clients, who they are and why you're targeting them, is of utmost importance. and understanding your target clients and how they want to operate will have a big bearing in how you sell your product. So it's so important to be clear on who they are, why they're being targeted, and the behaviors and needs of those customers. And then ultimately trying to build brand strength amongst those customers, because it's great knowing who your target markets are and how you might sell to them, but you need them to have awareness of your product, and develop that brand strength as you're doing it. Again, brand strength being another intangible value add to the investment or sales process. We quite often come up with clients who manage their finances excellently, and they have a product that they think is fantastic, but they don't know their target market. And that's when it becomes very difficult for us or the client to sort of sell the dream to the investor. If you can't pinpoint certain customers who've shown an interest in the beta of your product, or shown interest in buying the final product further down the line, if you don't have reference to who you're going to sell to, it becomes very difficult to persuade an investor that it's a viable opportunity. It sort of goes back to what we said yesterday about the 80-20-80 Pareto principle, and understanding your target clients, I would say, falls firmly into that 20% in the middle. That being, you should spend a lot of resource on that specific thing to get the maximum output from that, because it drives so much just knowing those target clients and how you might sell to them in the future. If you do know your target market well, then you probably have enough education on how you might sell. All of those questions that I posed earlier, I might have run through, and you think they can be answered very obviously. How are you going to sell? Are you going to sell in licenses or contracts or one-off sales and repeat custom? If the answers to those come to your head quite quickly, then you're probably at the point where you can sit down and start answering these questions in a mindset of, okay, we're going to go to market in a year. This is what's going to happen. This is how I'm going to sell. This is how many customers I'm going to have, and this is my average selling price. And your model sort of builds from there, as well as building in overheads and the cost of production. So if there was one thing for you to take out today, it ultimately is make sure that you know your own business and your own target market inside out. Quickly, just to recap what's in it, what we discussed today. The opportunity for investment is huge. I've seen some absolutely terrible products be invested in. Time and time again, we'll have clients come to us to help them finalize their investment round, and the product is not good. But investors are keen to throw money at startups in the UK due to EIS, due to SEIS and R&D. So the opportunity is large. You've all got to rely on yourselves that your products are good. Probably none of you would be here today if you didn't think they were good. So that part is ultimately down to you. You've got to sell it to the investor, because they'll want to know why should they give you their money, what you're going to do with it, short term, how you're going to spend it, how is that going to take your business to the next level, medium and long term, what's going to be their return. Of course, the investor ultimately will want dividends out of revenues and profits, or they'll want to sell a much more valuable 10% of a business than what they're picking up today. And to do that, you've got to consider the medium to long term of the business in line with all of the key value drivers, and communicate that effectively through a model which will require quite intricate knowledge of your target market, because ultimately revenues can only be derived from understanding your target market and penetrating it with the good product that you've got. So I think that is all I have to say on financial models and target markets. Hopefully there's a question or two, but feel free to either fire away now, or as per yesterday, Hannah will circulate my email address. Feel free to contact me on LinkedIn or via the phone if you've got anything else that you feel either myself or Dragon Argent can help with as you look to build your business. We're always happy to meet prospective new clients, offer up half an hour or an hour of our time pro bono, sort of no formal arrangements, just to help with certain things in the early stage. So do feel free to get in touch. But if you've got any questions that roll off the tongue now, then feel free to fire away.
Anyone eager to jump in?
Hi, Craig. Thanks again. Good stuff. Yeah, very, very clear. Do you have a kind of preferred template that you tend to use at all? Are there any good ones out there available for free online?
Yeah.
I've built my own over the years, but I just wondered what, if you have a go-to template.
It's hard to say because it's built up from scratch. Like I said yesterday, I tend to use Excel, and it will depend purely business on business. The initial template would just break down the costs that you foresee over the first year or so until you get to the revenue generation stage. Then I would probably try and build some assumptions into a separate tab of the Excel, which projects the revenue slightly differently. It's possibly not the answer you want, but I don't necessarily have a template. Each client is slightly different, and we try and keep it as simple as possible. A lot of the time, the more intricate you get with the projections, the more inaccuracies there will be. So they usually just are built from scratch for that specific client through Excel generally. And then once the Excel part is completed, then it's usually worth getting someone capable of knocking up a pitch deck that looks a lot snazzier than Excel can, which is surprisingly cheap and quick.
Do you tend to, one more quick follow-up question, don't want to hog it, but do you tend to, on that timeline, do you tend to tie in a cap table into that as well to try and model the dilution, or is that not something you do?
Generally, I wouldn't. It's not to say that you shouldn't. I think on the whole, the financial plan would kind of skirt around the cap table. What I would include in the financial plan is how much you expect to raise and at which points, just so that not only have you got your costs and potential revenues in there, but any boosts to your cash through investment. In terms of modeling a cap table, I'm not sure I would see that much value in trying to guess what your dilution is going to be, because it sort of is what it is, as best you can negotiate it as it happens. So I would model expected income in terms of investment and the runway that you would like that to last. So model the 500,000 coming in and being spread over 10 months over X, but I probably wouldn't go as far as dilution and cap tables.
Okay. Ta.
Thank you. I'm going to jump in again as well. Just asking kind of practical, because this has come up in conversations we've had previously with some of our entrepreneurs in terms of actually kind of presenting it, both in terms of conversations with investors. So while pitching, how much do you go into, at what point and at what stage? And the same then, I guess, goes for the supporting material. So what to include in a pitch deck, and there you obviously have the non-confidential one and how much to go into it in a confidential one.
Mm-hmm. So I think the main area of the pitch deck should be just to show exactly what separates you from the market, because ultimately that's what will drive interest in your business. So the pitch deck should primarily be about yourself, your credentials, and the product that you're developing, and why it's sort of answering a gap in the market or answering a problem in the market. I would say an average pitch deck that we see that we would advise on, and we do have someone internally that does sort of look over pitch decks and advise on them. That person isn't me, but I've seen enough in my time. Usually we would say something along the lines of 15 to 20 slides, with probably no more than 4 or 5 being in terms of financials, which might show revenue projections or cash growth or anything such as that in the short, medium, and long term. The overall story that you want to be selling is one of your product, because it's the product that will entice the investor, and the investor will make their own assumptions on how well that product could potentially be received in the market and how much of a problem that product might be answering in the market, and therefore how commercially viable it is. So I would fully make sure that your pitch deck is probably at least a third or a half of it is just discussing exactly what issues your product is resolving. And then the financials would be slightly secondary to that, as well as explaining in the pitch deck why the investment will benefit the company. The investors will want to know, as I've said, exactly what the milestones that it's going to take the company to, in terms of will this investment round complete the first round of development, or will it take it to full commercial viability? Because they'll want to see sort of stepping stones to enhancing the value of their investment in terms of their 10% share or whatever it is.
Brilliant. Do we have any more questions? I think that's a no.
Excellent. Well, great to meet you all briefly. Thanks for sitting through me talking for a couple of hours and the questions along the way. As I've said, do feel free to get in touch. No question's a stupid question, and like I said, we're fairly keen to meet people like yourselves to provide basic advice along the way to help you out on an informal basis, in the hope that you will grow, have very successful companies, and become fully fledged clients of ours in the future. So yeah, it's great to meet you all, and hope to hear from you again at some point soon.
Bye.
Perfect. I'm just going to, before you all leave, again, go into what Craig was saying. Please look out for our hub happenings, because we do have the monthly ones upcoming. So for March, you'll be able to book in on 4 different areas: accountancy, legal, and so on. So that's something to keep an eye out on if you want to talk to Craig or one of his colleagues more. I'll follow up with an email now with the anonymous survey. Those of you who filled it out yesterday, thank you very much. Please, can everyone do a strong effort and do that again today? It's really helpful. And in there as well, you'll be able to find the link for the event that I mentioned at the start of this session. So if you want another opportunity to meet with peers, other hub members, but also investors from our network, please do join us on 10th of March. All right. Thank you, everyone. Have a good evening.
Thanks, guys.
Right, thank you.
Thank you, Hannah. Thank you, Craig. Bye.
Bye.